Good. So loan programs. Again, so first-time home buyers, FHA, conventional, VA. What does that look like for Joe Blow off the street? First time. This is the first home. He's 5 years out of college. What program should he look at?
So I will tell you what most people do. After I precurse that with, there is no one size fits all.
Exactly.
There is no best option for every person ever. It really depends on, listen guys, if my job was as good as, everybody gets this loan, I wouldn't have a job.
Yeah.
Computers would replace me yesterday.
Yeah.
So we really look at what their goals are, what the specifics are of the situation. So I'll tell you what most first-time home buyers do is they look at 3.5% down FHA loan. That's typically what they do. It's going to be more lenient on guidelines, more lenient on debt-to-income ratios. We can get some exceptions on that. And also on credit score, it's more forgiving for lower credit or if you have any credit challenges. So there's just more options there.
Yeah.
So that's what most people, first-time home buyers, typically lean towards. And then also, typically it's 5% down for a conventional loan. We actually have access to a 3% down conventional loan option.
And that's a new program here within the last year or so, correct?
Yeah, about the last year.
Yeah.
So
great program. I like that.
Very good, yeah. And actually, typically you think, okay, I'm putting even less down. My interest rate's going to be higher. My PMI is higher. Actually, I'd say the majority of the DFW, you do have to qualify for, there's different limitations for income and different property limitations. But the majority of the Metroplex, I can find a program with that 3% to get you a really, really competitive rate and low PMI as well. So I would say if you have anywhere between 3 and 5% in any of those ways that we talked about, the gift, the checking savings, or the 401k IRA that we could tap into, then you could get into a house in that option.
Absolutely. Okay, so PMI, big question. So I decided I'm not going to put 20% down. So now I'm getting hit with this thing called PMI. What PMI? Break that down for people.
Yeah, so
using some mortgage jargon over here.
Yeah, PMI, I'm sorry, I dropped it, didn't even know it. So private mortgage insurance is what it stands for, mortgage insurance. This is not your home insurance. This is not your State Farm, Allstate, to protect your house from a fire or theft, right? This is mortgage insurance. So this doesn't protect me, this doesn't protect Fairway, this doesn't protect you, unfortunately. This protects the government.
Protects Fannie Mae.
Protects Fannie Mae, Freddie Mac if you don't pay on your mortgage. And yes, it's typically required. If you put less than 20% down, that was one of the things that they came out with was, okay, we won't make everybody put 20% down. The government will back these loans and keep them super low rate. But we're going to have this extra fee to help compensate the risk for the government side of things.
Right. How long does that stay on there? Is that forever? I buy a home, I get a 30-year fixed rate loan. How long does the PMI stay?
So it depends on a couple things. You can always refinance it at any time and get it removed with whatever loan program you go with. Depending on the loan program, it could drop off at 20%. It could be on forever. So that's going to be something that we're going to have to look at, when we're figuring out what loan program. One, what can you qualify for? Because we're always going to try to get you to conventional if possible. But again, if it's going to save you, the average person moves or refinances every 3 to 5 years. So I know, Mr. First-time home buyer millennial, you plan on staying here for 20 years.
It's my forever home.
You're going to stay. You're going to build a family here.
Yes,
it's going to happen.
Never moving.
Statistically, let's say you refinance. Let's just say you refinance. Then we're going to look at more of a shorter term option because statistically you're going to either refinance or sell this house. And if there's an extenuating circumstance where that really is, we'll get to know that with a buyer and we'll say, okay, let's look at this other loan strategy instead because this, you're an anomaly to this statistic, right? But for the most part, it can take anywhere from 2 to 3 years to drop off with the current market appreciation.
Okay, perfect. Now, what about, so I'm putting my 5% down, what if I got a second loan at 15% so I can bridge that and not have to pay PMI?
Yeah, so second lien, right?
Yeah.
So that's a question I get. So I'll answer the question, yes, it's possible. Yes, people ask me about it. 90% of the time, it's not the best option for the buyer, and they will actually save money by doing PMI on the loan versus a second lien. So it's kind of one of those things that sounds great in theory.
Okay.
Like, yeah, PMI, we don't want to pay PMI, it's terrible. Well, really, it's
what kind of interest rate are you going to be paying on that second?
It's really high. So it's over 6% typically. It's a shorter term. So instead of PMI, we're talking about, depending on your price range, maybe $100 a month.
Okay.
Depending on how much you put down. So it's not a ton of money. I mean, it's $100. It's a lot. But we're not talking about like $500 a month or something crazy.
I mean, it's $100 that you're lighting on fire every month.
Which
nobody likes to do.
Nobody likes to do.
I love burning $100 bills.
But if you're paying $1,200 a rent, you're burning $1,200 a month.
Exactly.
So $100, buy a house now, build your equity and net worth, or $1,200 for.
We'll dive into that a little bit more because I do want to talk about rent versus buy here in a second.
Yeah.
But you would say with the 15% second lien, great on paper, in practice, in most situations, probably not going to be the best option.
Yeah, I do it a lot with higher net worth clients, with clients that are buyers that are maybe as a bridge loan, they're selling a house and they want an option to be able to not have to sell it. There's advantages to it. It has its place. But most of the time, unless people just really have a giant hatred for PMI aimlessly without reason, I typically don't recommend it.
Okay. So we touched on rent versus buy. I want to get into that a little bit further. But let's talk about, we said timeline. So average person sells or refinances within 3 to 5 years. So I just got a job here in the area. And I know I'm going to be here for at least 3 years. This is going to be my territory for the next 3 years minimum. I might have to move after that. What is that point that it makes sense to buy versus to just say, I'm going to go ahead and get an apartment because I'm not sure where I'm going to be at in a few years? Where is that break-even point for most people? Let's stick around that, I'd say, entry price point, $250. So I think that's going to be where most people are looking, especially with home prices where they are right now. That's going to be kind of your entry point. So where would be that point where, okay, it makes sense to buy versus renting?
Yeah, good question. So it really depends on how the loan is structured. A lot of my first-time home buyers, we know that up front, that statistically they're going to move every 3 to 5 years. And then also, depending on their market, let's say they're computer sales, and they have a history of moving every year. Okay, well, we're going to need to structure this loan really differently than your parents that are buying their forever house and staying there for 20 years, right? It's a totally different conversation. So for the most part, I mean, I would probably say there's a saying, and it's, you don't lose money when you buy a house, you lose money when you sell a house, right? So there's actually more costs when you sell your house versus when you actually purchase a new home. So keeping that in mind, really we have to look at, the cost on the back end and foreseeing that. And I would probably say 2 years. If you plan on staying 2 years.
So your cost on the back end is selling, and this is where I need to keep the people from pitchforks and torches to come find my house. It's going to cost typically anywhere from about 7 to 7.25, primarily based on commissions. So that's going to be, you have your commissions, and then you have about another 1 to 1.25% of title policy, attorney's fees, underwriting. I mean, just all the fees that go along with selling a home. It's going to be about 7 to 7.25 if you're paying full commissions. Could be slightly less, but that's kind of that number to work around to say, okay, I need at least that much appreciation to break even. So,
which, I mean, you're the real estate expert.
In this market right now, I mean, we've seen
last year. What was the appreciation?
13.5% in most areas.
Insane.
You're seeing it in 1 year. Now, we're kind of seeing a shift in the market. I'm going to do a podcast on that down the road because prices are changing. We're kind of seeing the market slowing down, and again, that's going to be on price points. So I'll talk more about that later. So we're going to stay here on topic, but I want to, so really 2 years is kind of that, is that?
I'd say 2 years. My personal thought, now I bought our current house right now and I had the best idea ever. First person ever to have this idea. I'm gonna have my 2-year-old child and my wife who hates moving, and we're gonna move every 12 months, and we're gonna buy a bunch of investment properties.
You and me both. We're gonna go in and fix it up, and then turn around and make a ton of money.
Yeah, that was 3 years ago. I've done like 2 things to the house. So we all think we have a crystal ball. We think we know what's going to be next and how quickly we're going to move or what our job's going to entail. My recommendation is, if you think you're probably going to be in the same general area for a couple of years, take the plunge, buy a house. You won't regret it. We can always figure out a good way to make it work. Don't be scared of your timeline. Don't let that timeline prevent you from taking that first step.
Absolutely. That reminded me. Okay, so talking about jobs moving around, we're going to have to backtrack a little bit. So I'm in sales, obviously. I'm in real estate. But I have buddies who sell software, who sell cars, who they're in sales. To apply for a loan, I guess we're going to have to backtrack a little bit. Let's talk about, what does that look like, your job, your income? Because most people, obviously, the most money they have, we're not trust fund babies. We don't live off of capital gains. What career, how does that apply towards qualifying for a loan?
Yeah, so there's always exceptions. There's always ways to get to the finish line. So I don't want to disqualify anyone from saying anything. So if you don't fit in this box, that doesn't mean you can't get a house. It just means it's another conversation we have to have. So typically what lenders are looking for, again, Fannie Mae, Freddie Mac, what they're looking for is 2-year consistency. That's what you'll always see through employment. So what they figure is, man, that's great that you could go out and sell blenders to a bunch of restaurants for 6 months and you made $100,000. Was it luck? Was it you knew somebody? Is it going to run out? I mean, we can't use that based off of, to project what you're going to make for the next 30 years, right?
Exactly.
So what they figure is, if you can do something for 2 years, you're going to be pretty good at it. It's going to stick, right? There's a pretty good chance. So they're looking for 2-year consistency throughout whatever you're doing, whether that's a specialty job. Maybe you're a nurse, and obviously if you're a nurse, you don't have to be a nurse for 2 years, but you went to school for a really long time to be a nurse, right?
Yeah.
So we're going to use that schooling as your 2-year history in the field to show that you're qualified to do that job.
Okay.
If you are a $10 an hour cashier at Kroger, good for you. You're an unspecialized employee. You don't have to have a history. You just have to be there for a few months.
So a salary position.
Yeah.
I could take a new job and I have a guaranteed, this is my salary every single month, and this is what I make a year. That can apply right off the bat.
Yeah, we'll say 6 months most of the time is where we want to see that. If you're any kind of a commission job, really ideally that any lender wants to see 2-year history with any commission, bonus, or overtime history.
Okay.
Because they're variable. There's exceptions to get you to the finish line with 12 months or sometimes 18 months. But 2 years in an ideal world is what mortgage lenders want to see.
Okay.